We've got none other than Crowdstrike today. Just reported earnings after hour. You see quite a healthy little response here to these earnings, up 6%. Pretty nice if you're a shareholder here, obviously. You might notice they've updated this Google stock screen just a wee bit. So just a wee bit of it updated. So really exciting stuff here. One thing you need to note, over the last year, this has been a very favorable stock to own. Can't deny it. The stock's up over 400% in the last year, which is obviously worth mentioning. Today, stock was down 2%. Pretty mixed day overall in the market. But after hours, see some pretty good movement. So we'll take a look at these earnings. They've been consistent with their beats in terms of this company. They've been consistently beating numbers and estimates for several quarters now. I mean, we're talking about years worth of beats. They just keep rocking it. Let's look at these earnings. Q4 non-GAAP EPS of 14 cents is a beat by 6 cents, but a GAAP EPS of negative 9 cents actually misses by 1 cent. Not a shocker, obviously. GAAP profitability is something this company's still searching for. They're still working on the process of that, and it's somewhere that they will get. Obviously, there's massive improvements year over year, and I do think they will end up reaching that profitability standpoint. Most likely, it'll be darn close next year or this full fiscal year 22 for them, but I do think it won't be until fiscal year 23 that they have a full year of profitability. So keep that in mind. Revenue standpoint of $264.93 million is up 72% year over year. Really nice improvement there. And it's a beat by 14 million. So nice to see that. The major news on this quarter listed right here is that annualized recurring revenue, so just due to obviously services rendered, annualized recurring revenue, so this is guaranteed money in the pocket, baby, off of the people signing contracts with them and people doing services with them from a subscription standpoint, comes in at $1 billion for the first time ever. Yeah, that's some pretty awesome stuff. For the quarter, net new annualized recurring revenue came in at $143 million, so they added quite a bit of that, and that boosted them over $1 billion for the first time ever. Pretty exciting to see that because the company's in a growth format. I mean, annualized recurring revenue of $1 billion, give me that, baby. I'm all in, okay? Net new customer growth accelerated as well. They added 1,480 net new subscription customers, which obviously assisted towards that 143 million line that they showed. Quarter one outlook, they're expecting total revenue to come in at 287 versus to 292 on a non-GAAP EPS of 5 cents to 6 cents, which will equate probably close to a GAAP EPS close to a negative 15 cent line. Q1, again, it'll be an improvement year over year, but still not profitable. For the full year, expecting total revenue coming in at 1.3 to 1.32 billion dollars, and a non-GAAP EPS of 27 cents to 30 cents. So overall, pretty nice guidance there for this company, showing some pretty significant growth actually. So given that growth factor there, which is pretty exciting, you have to consider that this is a company that managed to pretty well beat on every aspect here from the profitability standpoint, which was darn near. It was a non-GAAP beat, but a GAAP miss. So they darn near beat every aspect here. They beat on the revenue standpoint and the guidance. Pretty nice. Very nice stuff right there. Revenue up 74%. Subscription revenue was up 77%. Annualized recurring revenue obviously topped $1 billion as we saw. Subscription gross margin came in at 80%, improvement of 77%, and that's where these subscription models are so significant because the margin's quite nice. It's quite nice when you get into the nitty-gritty of things and you figure out your business model. You can have quite the nice margin here, and as your business grows with that level of margin, you just find yourself into profitability naturally, and that's where this company is going to be at. They're not going to need to do anything special. They'll just find their way naturally. So really exciting stuff. Obviously, consensus on revenue was really only a $268 million number, and they're expecting 287, so quite significant. And obviously, full year guidance as well. They're expecting a beat compared to that. The only difference here comes from the full year EPS line. The consensus is actually 33 cents, but they are showing that they're going to be doing 27 to 30 cents, so a little bit below that. So again, as I mentioned, almost a beat on every aspect, but not quite. So it is, it's a really good quarter, but it is almost shocking to see the stock up so significantly, because typically if there's any one flaw in this market, they'll eat you alive. They're eating you for dinner, okay? I'm hungry, by the way, very hungry. Speaking of dinner, what should I eat today? It's a good question. I was thinking chicken. Obviously, love chicken, but let's look at the press release. Not get too out of whack, because I do tend to do that. Believe it or not, I get distracted sometimes, as you might know. Annualized recurring revenue is up 75% year over year, as we saw, at $1.05 billion. Very nice. GAAP loss came in at $15.8 million. Now that does compare to $31.1 million of the fourth quarter of last year. So again, as I mentioned, quite a significant improvement. We're talking about a company that was able to have their loss. So by these standards, probably 2 years from now, you'll expect to see some profitability. I'm really hoping they can pull it off. And from a non-GAAP standpoint, they had a $34.4 million income line, but that compares to a loss, even a non-GAAP loss, last year's quarter of 6.7. So quite the improvement there as far as income from operations, for sure. Net loss in general came in at $19 million compared to $28.4 million of the year prior. So still quite the improvement there. You got to be happy with that if you're a shareholder of this company. For the full year, revenue grew 82%. Pretty nice. Subscription revenue grew 84%. Subscription, I don't know why I said it so weird. And net loss for the full year came in at $92.6 million. That compared to $141.8 million of the year prior. So quite the improvement there. You like to see it. By these rates, 2-3 years down the road, they'll be going ahead and rocking it. So customers that adopted 4 or more modules, 5 or more modules, 6 or more modules increased 63, 47, and 24% respectively. So every aspect of their business just going at it. Even the increased number of modules, they're managing to do it. They acquired Humio, which is a leader provider in high performance cloud log management and observability technology. So again, this is nice stuff. The company's doing good things. I do want to look here at the balance sheet as we do. See what they're able to post here. It's a year-over-year comparison. Total current assets coming in at $2.3 billion compares to $1.2 billion of the year prior. And you'll see this cash and cash equivalents line is quite significant. They raised a good bit of capital over the last couple quarters. This quarter they raised around $750 million. I think the quarter prior they did as well. So you're going to see that come into play into the debt line. But again, total assets in general coming in at 2.7 compares to 1.4 of the year prior. So there is some good growth there. Liabilities. Current liabilities at 863 compares to 493 of the year prior. So definitely an increase there. Not a shocker, obviously. Now, obviously, some people might look at this and see some concern here. I don't think it's horrible. The total liabilities in general, obviously they raised a lot of capital. Long-term debt here rose quite a bit. They didn't have any prior. Now showing a $738 million line there. It can be rough for some people, but it's all in the mercy of the cause of growing this balance sheet, right? Total liabilities coming in at 1.8 compares to $662 million of the year prior. So very significant increase there in debt. But overall, they did raise their assets more than they did their liabilities. $871.8 million on the stockholder equity line. and 742.6 is what they had a year prior. So the balance sheet grew, the equity line grew. So overall, they were doing something to boost this balance sheet. Now you look at it, obviously, valuation of the stock is pretty important. We're talking about a company that brought in $800 million last year, trading in a market cap of $43 billion. It's quite significantly high. I mean, we can't lie. There's no PE ratio on this company, no forward PE ratio, because next year they won't be profitable. So you have to consider that when you're looking at this company. It's right near it's near high levels. We're talking about this company has a 52-week low of $32. Right now sitting at $200. So I think the valuation's a little too steep for me right here in these levels. And I think, frankly, you should see some pullback at some point, because this type of valuation can't continue on forever. This is, in my opinion, an overvalued stock. Now, if you got into it beforehand, around the $100 range, you've made a steal. You've made a killing. But again, what can I say? I think it's just a little bit too rich for my blood. Hope you enjoyed this. You have a great day.